Good morning. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, bringing you the morning comment for the 16th of August. RBA August minutes upbeat despite the rate cut. Overnight, the Reserve Bank of Australia released the minutes of its August policy meeting, where the officials slashed rates by 25 basis points. The minutes show that even though inflation was likely to remain low for a while, the prospects for growth were positive, and even stronger growth could be assisted by lower rates. There were no hints that the RBA is planning to cut rates again this year, and the overall tone was more upbeat than one would expect from a bank that just eased its policy, in our view. Aussie USD traded in a choppy manner after the release, but took a direction and moved higher in the following hours. In the absence of any easing bias in the meeting minutes, as well as the statement, we believe that the Australian dollar is likely to remain resilient in the foreseeable future. Furthermore, investors' search for yield in a low-rate environment could also add some support to the Australian dollar. The next major risk event for the Aussie traders is likely to be the release of the nation's employment data for July, due out on Thursday. Expectations are for the unemployment rate to hold steady and the net change in employment to remain positive and rise further, something that enhances the case for the Australian dollar to remain supported for a while. Elsewhere, San Francisco Fed President John Williams released an essay in which he called for policymakers to rethink the current monetary and fiscal policy frameworks. He is now the second FOMC member to advocate a change in how policy is conducted following James Bullard. Williams argued that the economy is a new normal of low neutral interest rates, and since that is likely to stay that way, changes should be made so that the economy can better cope with future recessions. He suggested that the Fed should consider raising the annual CPI target from 2% or replace its current inflation targeting regime with nominal GDP targeting. Both approaches, he said, are likely to give the Fed more flexibility to lower interest rates in response to recessions. As for today, the UK CPI data for July are due out. The headline rate is expected to have remained unchanged, while the core rate is forecast to have ticked down. Nevertheless, we see the risks surrounding this forecast as tilted to the upside, and believe that both rates may have risen, supported by sterling's depreciation following the Brexit vote. Even though it may be too early for inflation to be substantially affected by a weaker exchange rate, we still expect some signs of this to appear in this data. However, given that the rise in inflation is not linked to the broader performance of the economy, but mainly due to the GDP depreciation, it seems unclear to us whether sterling will benefit from accelerating inflation in the coming months. In its August inflation report, the Bank of England signaled that even though the CPI rate may rise much faster than previously anticipated, policy is likely to remain accommodative or even be relaxed further in order to support GDP growth. We therefore believe that upcoming inflation prints are likely to attract less market attention, considering that they may no longer have the same influence over the Bank of England's rate path. From Germany, we get the ZUW survey for August, and the forecast is for both the current conditions and expectations indices to have ticked up. The survey showed very subdued sentiment among German economists and analysts in July, with both the current conditions and expectation indices declining by more than anticipated. The expectations index unexpectedly collapsed into the negative territory to reach its lowest levels in 2012. Considering that the main reason was the Brexit vote and that the IFO survey as well as the PMIs for July showed that German businesses were not so pessimistic, we expect both the ZUW indices to rebound somewhat in August. This could support the euro a bit. We also get the Eurozone trade balance for June, though no forecast is yet available. From the US, we get CPI data for July. The headline CPI is expected to have slowed somewhat, while the core CPI rate is forecast to have remained unchanged. A modest slowdown is supported by the nation's ISM manufacturing and non-manufacturing PMI reports for July, where the respective price indices declined, but remained within the expansionary territory. We don't believe that a minor tick down in the CPI will push back expectations for the next Fed hike, given that the committee pays more attention to the core PCE index, and especially after officials admitted at the latest gathering that risks to the US outlook have diminished. As a result, the reaction in USD at this release may remain limited unless we have notable deviations from the forecast. We also get the nation's industrial output and building permits both for July. In Canada, manufacturing sales for June are due out. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Sakis Paraskevov, Senior Fundamental Analyst at IronFX, wishing you solid trading.